Thanks everyone for joining the call. So excited to chat with you guys today about Opendoor's earnings. This is a big week, really, for iBuying. We have OfferPad tomorrow, Opendoor on Thursday, and then Redfin on the 9th. But really, just wanted to take some time to walk through the implications of the estimates that we provided, and answer any questions that you guys might have sort of for the company, residential real estate as a whole, and so if anyone has any questions about these estimates or comments, I'd love to field those now and start digging into the thesis.
Should we maybe first go through the estimates and read them out again, just in case somebody didn't read the article?
Sure. Yeah. High level overview. We estimate that Opendoor sold over 8,000 homes, 8,300, 8,400 at the midpoint. For revenue, big beat on the top line, 3.3 to 3.5 billion. A miss on the bottom line with adjusted gross margins 3.4 to 4.4%, 112 to 154 million adjusted gross profit. Contribution profit margin just over 0% at the midpoint, so negative 0.4 to positive 0.9%. And then adjusted EBITDA of negative 169 million to negative 200 million. And then homes purchased 7,700 to 8,400. So high level, basically, what we're seeing is a huge beat on the top line, as September is now Opendoor's second highest month of sales ever, after March of this year. So they sold 500 homes on September 30th. That was driven in part by realtor commission bonuses and really just aggressive sales velocity by the company, which has allowed them to sell 2,000 to 3,000 more homes than they guided for. But what that means is that they sold off more inventory than they expected, right? And that's the inventory that's probably marked down. And so as a result, those lower margin homes were pulled into third quarter rather than Q4. And so that dragged down the relatively higher margins of July, for example, which is why we expect adjusted gross margin, contribution profit margins to come in lower than guidance.
All right. Any questions? You can just request to speak, and we're gonna take you up here.
People are feeling kind of today. Sebastian, is there anything that you felt like was sort of unique about the data that you thought was worth chatting about?
Yeah, I guess what really surprised me is how they were able to turn around the really low sales volume from, I think, started like July, beginning of August, to like what we've seen the last week of September. And we saw that they used multiple strategies. One was the bonus for agents that you mentioned, where they gave, I think, a $3,500 bonus if the home sold by September, or closed by September 31st. That was definitely a big part of it. But they also changed their strategy in how they adjust prices on their listings over the quarter. And that probably made a big impact as well. So we are seeing that Opendoor is changing their strategy. And that's a good thing. They're reacting.
Yeah, I think one of the other one of the other items that's probably worth commenting on is just how hard this quarter was to track from a data perspective. Prior quarters, when you look at things, you can sort of extrapolate current trends into the future and say, hey, July sold X amount of homes and pendings are rising. So I think that, it'll be slightly higher in August. But that was not the case this month, right? We saw a rapid deceleration in sales volume between the months of August and July, and then rapidly increased velocity in September. And so not only was it difficult in the volume perspective, just knowing what it's going to look like in the future, but then also margin is really difficult too, right? Because you have markets like Atlanta, which estimated gross margin of 8% in the quarter, versus Phoenix, which had an estimated gross margin of negative 2.9% in the quarter. And so when you start thinking about the fact that their two biggest markets had a 1,100 basis point difference in estimated gross margin, you start to wonder, okay, well, what does margin look like in non-disclosure states, right? Because Texas, for example, how many sales were in Texas? Opendoor had over 1,800 sales in Texas in Q3, and we don't have the margins for those sales, right? And so is Texas an Atlanta or is it a Phoenix? It's really hard to know. And so part of what we're most closely looking at going into this earnings is how did Texas actually affect the basis of Opendoor's sales when it comes to margin? Because it really could have an outsized effect on the margin for this quarter, much more than traditional, because usually we generally expect Texas to be similar to the rest of markets. But in this sort of have or have not type of market, it's hard to know what type of margins those markets are posting.
Hey guys, can you hear me?
Yes.
Yep.
Number one, kudos for you guys for putting this on and for continuing to preach the gospel. So I appreciate it. Two questions for you. Tomorrow is OfferPad earnings. Any thoughts on what to be looking for in those relative to Opendoor, or even if it matters too much? And number two, have you seen any owner-owned exclusives go pending yet? And any thoughts on, if not, when, why we haven't yet? Is the numbers just too small, or any thoughts you want to share on that?
Yeah, so I'll probably take the first one and part of the second. Maybe Sebastian can answer definitively on the second, because he's actively watching those consumer-owned homes in Opendoor Connect. So I'll touch on that for sure. But I think in response to your first question about OfferPad, at least anecdotally, what we're seeing, because we're beginning to track OfferPad data, I think by the end of Q4 we should have a pretty robust system for tracking complete OfferPad data. But as of right now, what it seems like is that OfferPad is going about this downturn in a very different way than Opendoor. So just to give you an idea, in response to this massive downturn, Opendoor said, we need to clear out this markdown inventory at all costs, right? We need to blow the doors off with our sales team and just get back to profitable unit economics transactions, because their concern was, we've got these underwater homes. There could be another market downturn, and in the meantime, we're paying holding costs, right? HOA, property taxes, insurance, et cetera. And not only that, but this debt is locked up in these unprofitable homes, which means that their flywheel can't be spinning. And so Opendoor said, let's sell all these homes and get back to a neutral as quickly as possible. And I think that they've been successful in that. OfferPad, on the other hand, has said, nope, we're not going to sell homes at a loss. We're going to wait, and we expect that prices will come back. And so what I would expect anecdotally is that we're going to see volume come in a lot lower than expected for OfferPad, and probably more of a stabilization of their sales and purchases as a result. And so I think that's going to be the big difference between these companies, because fundamentally they're navigating this downturn in very different ways. And then to kind of touch on what you said about Opendoor Connect, I think it's really important for us to remember that Opendoor exclusives, and then also having consumers post their homes on Opendoor's third-party platform, are brand new products, which there's not really a household name alternative solution, right? And so that requires a lot of consumer education, marketing, testing, and we've really just known about this for a week or two. And so, like exclusives, it took them a while to get their first sale for exclusives, and I think that's something that we're going to see the same for Connect. It's something that they're testing and they're trialing, and Sebastian will know more definitively if a sale has actually happened, but I would expect it to be slow going for the foreseeable future. I wasn't expecting a third party marketplace for several quarters at least. So I think it's a very interesting development.
Yeah, looking at the data, we haven't seen any of the homes that their owner they're not owned by Opendoor actually going to pending or sale. Right now, they've only really listed these homes for a little. The first homes went on the website just a little bit over 2 weeks ago. So, and they started with like 1 or 2 homes. So it's gonna take a while until we see conversions there. So right now, they started this in Dallas and they expanded to Austin, and we expect them to do that soon in Houston as well. And what's interesting here, it's really not just about the buyer pipeline, like or the buyer funnel, like with Opendoor exclusives and their own homes. They really have to optimize the seller journey there. Like, what is the why should a seller list their home on Opendoor exclusives first? And we saw some really interesting exploration there and redesign of their UI and the experience for a seller. So and that is rapidly changing. Like literally, the Opendoor exclusives page and the seller portal for Austin, Dallas, and Houston are changing on like a weekly basis. So we will see them learn and get to hopefully to product market fit with both of these products, the seller and the buyer product. And then the next step would be to scale it to more markets.
I can throw another crystal ball question out here for you.
Love it.
Yeah. Tell me when Opendoor will launch the customize your new home before you move in concept.
Yeah, so I think they're certainly toying around with that right now, right? Sebastian, we've got like screenshots, I think, of potential options to customize your home before you move in.
Yeah, we've seen some design mock-ups that are a bit that happened a few months ago, as well as they actually ran an experiment with renovations back in 2019. So we know that is something that they have been like actively experimenting with. Now the question is when it comes into Opendoor exclusives and the actual buyer checkout process, or buy with Opendoor, even better. Like if you could buy any home on the MLS with buy with Opendoor and customize your home, that would be a huge value add. We hope we will see it soon. I'm sure the timelines got a bit scrambled up here with what's happening in the market, and they obviously want to cut costs as much as possible. So scaling out their vendor network to do renovations doesn't seem like the right timing, but we'll have to see.
Would guess mid 2023. I think that's probably a good timeline where they'll feel more comfortable to reinvest in these types of interventions, because at the end of the day, like, yes, the most important thing is getting the iBuying right? Because if you don't get that right, everything else fails. But also, it's important to remember that iBuying is not enough, right? Like, this is not a good investment if all Opendoor ever does is iBuying. And so the company seems to be aggressively pursuing ancillary opportunities that improve the unit economics. And the ways to improve the unit economics are myriad, right? There's economies of scale, so boosting volume, cutting costs, right? Just becoming a leaner ship. But also, you have this exclusive situation where you don't have to pay 2.5% to 3% commission, for selling a home, which is a tremendous amount of money. And I posted about that the other day. And then you have this third party marketplace where you're able to take 50 to 100 basis points on a transaction for a home that was never on your balance sheet. And that's all profit, right? That's all incremental profit, which is really powerful for the company. And that's the long-term vision of what makes it such a compelling investment. But then down the road, we also have these things like, probably not mortgage for a long time, but we do have this renovation idea, which could definitely sweeten the customer value proposition on the buy side. And so we see all these things on the buy side because the buy side is where that juicy margin is. And sell with Opendoor is probably not going to get much better than title and escrow and your 5% fee. But the buy side is really where the company becomes much stronger margin wise, much more resilient, even in the face of ridiculous housing downturns. And so that's something that, although probably not super worthwhile to invest in aggressively right now, I think must be a near-term objective to make the company more bulletproof in the face of further housing volatility. And the entire time that Opendoor has been a publicly traded company, housing volatility has been closer to crypto than U.S. residential real estate, which is tough.
Hey guys, I'm just gonna chime in here. Hi Tyler, hi Sebastian. Thank you for all your work. I really appreciate it. It really helps, during these times. So just to understand, I guess the nature of this call is simply. So I come from a valuation background. I'm just looking at the data, and I was just hoping if you guys could just help me out, right, with the guidance. So I see the Q3 guidance was, as per data door. We're looking at somewhere close to negative 200 EBITDA, 200 million. So, guys, what was the Q1 and Q2 adjusted EBITDA profitability?
I don't know off the top of my head.
I apologize, because I should have done some work before coming to the call. I'm just curious. So, because I look at it from the annual perspective. So, if we're sitting somewhere close to 50 to 100 million in Q1 or Q2, we add that up. And if we can exit the 2022 fiscal year with a negative 100, 150 EBITDA, that's still not bad given how fast the interest rate moved, because that was not modeled by Opendoor. And I understand the conversations about these extra additional services that they can add to boost up their margins. But I guess so over the weekend I had an opportunity to speak with a customer. So I spoke with 3 customer service agents and to find out more about the 3P marketplace, which they started in the beginning of the year. And what the agents told me, because they have taken it out after the second half, which kind of makes sense because they obviously they were focusing on getting rid of that inventory that they bought. So I understand that. Now going forward, what I do see, and this is strictly just my opinion, you guys can correct me if I'm wrong, At this time, right now, the biggest worry for them is to get rid of that inventory, get this fresh inventory in, and get into the positive profit contribution margin unit economics. That's the first step. As in regards to the 3P marketplace, where they don't even need to bring their house into their balance sheet and people can just sell on their website, that would be a great product. But I do not see that happening until we see the terminal value or the terminal multiple being established in the market, right? So I won't be focusing too much on that. But what I wanted to have a discussion on is, given what we know, right, and given what we can exit the 2022 EBITDA, even plus or negative. Given that, we can work backwards and find out what the multiple should be on that revenue number.
Yeah, so I just looked up their adjusted EBITDA for Q1 and Q2.
Okay.
It was roughly positive 400 million. So
Mm-hmm.
I would be shocked if Opendoor ended the year with an adjusted EBITDA less than negative 150 million.
Okay, that's a perfect start, right? So let's take that expectation, right? Let's just do negative 150, right? So we'll scratch that EBITDA of zero EBITDA. That is still not bad, given the faster the speed of the interest rate that went up. Because in 2023, we're looking at, so the Bloomberg future implied interest rate comes out somewhere. Now it has moved up. I recently checked it this afternoon. It was 4.5% to 5%. That's where they will stop. Now, given that, but the market will react 3 to 4 months before that, because they will know that we will pause it. And so, what's your opinion? Given that we will be sitting somewhere close to 4.5% to 5% in first half of 2023, where do you guys think the mortgage rates would? I don't think they will move much from 7%. They'll probably go 7.5%. What do you got? What's your opinion on that?
I would say if I knew what direction mortgage or what absolute value mortgage rates were going to, I'd be a billionaire right now. That's like a
let's just pick a direction. Like, okay, so we know we're sitting at 4.5, right? Where the Fed rate is at 3.7%. We're gonna get a 75 tomorrow. 2 years. 0.5%. So 10 years at 4%. The max I can see it's going as per the option or the futures market for 2023 is 5%. Okay, that's somewhere close to. Let's just take another. Well, we're gonna get 75. So that should from going from 25 beeps to 4.5%, right? And the mortgage is sitting at 7.1%. I think most of the legwork is already done. It's pretty much now the incremental increase in mortgages. I am speculating somewhere close to 50 to 75 beeps.
Yeah.
Now, if we can quantify that additional incremental 75 beeps impact on the house prices, it's not. I don't see it having much more impact than what we just felt in Q3. To be very honest, I don't think we would be seeing that the amount of decrease in the house prices, that intensity going forward.
Yeah, I think our baseline estimate is that we are not going to have, to your point, not going to have a housing downturn of the same magnitude that we saw in the late summer. I think there was a lot contributing to that, but notably, what also contributed was that the absolute delta was actually a lot bigger than a lot of people think, because people say, housing went down 10%, peak to trough in some of these markets, right? But that's not including the fact that housing was going up on a month-by-month basis before that, and so when you're pricing these homes, you're including really that rise in your estimates. And so what I mean is, like, Opendoor is saying they're seeing month on month HPA, And so they're saying, okay, we're gonna pack that into our offers because we expect homes to become more valuable in the future, not less. And so the actual peak to trough includes that positive HPA, of the month before, and then negative on the other end. So you end up having
and
this
which is
much.
what inflates the price discount. Is that what you're saying? Which is what inflates the price correction percentage.
Yeah, I just mean it wasn't like we had a flat market and suddenly dropped 10 points. We had a rocket ship that came that achieved terminal velocity its way back. And so that's a very different market price because
correct
because of that extra delta from up to down. And so I think to your point, I'll say again, I have no idea what's going to happen with mortgages and interest rates and the Fed. But I do think that the biggest drop has happened. Do I think that there's still going to be some pain in the housing market? 100%.
100%. I'm on that board too. I'm on that same shit. It's good. The housing market usually reacts 14 to 60 months past the bottoming of the S&P, right? So real estate takes time, and these rates will take time for the real estate to act accordingly. But what I'm saying is, I think the pace of the decrease, where the end destination is, I think that will not be that drastic. And Opendoor has learned its lesson in the previous quarter and has adjusted its spreads. If anything, what I sincerely believe is the fact that, given the service fee of 5% and the spread that they're using right now to build that inventory, this might be positive in the coming future. Those inventories will be worth it would be in a positive direction, and if you ask me, but they have to get rid of. So how much of the inventory is left from March, June, and July? Is 5,000?
I don't know the number off the top of my head.
Okay.
I think they had like 17K at the end of last quarter.
Yeah.
So if you're assuming they sold 8,500 more or less, and then they purchased around 8,000, it's probably around the same number.
So the old inventory is somewhere close to like 8,000 to 9,000, right?
Hey guys, thanks for doing the call.
It's tough to value, man. I don't know. I try to just try to get to right now. Do you guys talk about stock prices or the company valuation at 1.3 billion? Because that was the last Series D round. It was done at 1.3 pre money. Post was 1.8. And right now we're sitting somewhere close to 1.3 billion market cap, which is very surprising to me. And I won't be surprised if any venture capital company comes in and gets not VC at particular, because they're not allowed to do so, but other mechanism that they can use to. Because there was news in the market that some VCs are now getting into high growth companies because the valuation matches because the private markets are not adjusted as much, and these guys will come in and we'll be picking up these high growth companies. So I don't know if you guys have any thoughts around that.
Yeah, I mean, could be. I don't expect Opendoor to sell or anything like that. But yeah, a lot of the prices for some of these companies right now is getting to a point where if you've got deep pockets, it's starting to look like a pretty good deal.
Hey Tyler,
hey, guys.
Hey, sorry, Mike. Go ahead.
Yeah, thanks. Thanks for doing the call. You guys had talked about the sales activity in July, August, and then the pickup in September. I'm wondering if you could touch on the purchasing activity and the cadence, maybe by month, as the quarter unfolded. Thanks.
Yeah. So we saw pretty sharp deceleration in purchases each and every month of the quarter. I think part of it was we have a lot of inventory and it's worth less than we thought it was. Part of it was we want to stop catching falling knives and figure out where this market's going to settle. And so instead, the purchases that they did make were very, at least now, what looks like very intelligent purchases. And so when I say very intelligent, what I mean is that it's manifesting as really phenomenal embedded margins for all homes bought in August and beyond. And so August, September, October, you add those together and average them out, it's double-digit embedded margins for those listed homes. Before that, July is kind of the midpoint of this most recent cohort, and then June, May, April, those are all garbage. But yeah, I think in terms of the cadence, it dropped each month through Q3, and obviously purchase data are delayed about 4 to 6 weeks, so hard to know what exactly the October cadence will be yet. But September was lower than August and July.
Thanks very much.
Hey, Mike, I had two quick questions. One actually, sorry, hey Tyler, I had two quick questions. One's following up on Mike. It looks like you guys have. First question is, it looks like you guys estimate around 8,000 homes, 8,000 to 8,100 homes purchased at the midpoint. It seems to me like it still seems like quite high. Obviously, it's lower than how many they purchased last quarter, but in kind of a like a quote unquote down market, it still seems relatively high. But I'm just curious what your thoughts are on like the absolute number of homes that they purchased and kind of their strategy for still keeping up such a high pace of home acquisitions.
Yeah, great question. Everyone kind of knows that Opendoor had 17,000 homes in inventory at the end of Q2, but I think one of the things that we often forget is that Opendoor also was under contract to buy 7,000 homes on the last day of Q2. And so, in their earnings call, they discussed the fact that they wanted to honor those agreements, even though they knew that the moment that they signed those agreements, those homes would be worth less than what they purchased them for, which a decision. And I think there's two sides to sort of evaluating how reasonable that decision is, but they felt like it would improve their brand if they followed through with that. And so it was the 17,000 homes, but then they also had 7,000 homes under contract or something thereabouts. And so when you include that in the 8,000 figure, it's not as much as I think it originally sounds like. And certainly, in September, September is their lowest month of purchases since June of 2021, by a lot. And so that's one side of it. The other thing I'd say is the only way to raise margins across their inventory is to purchase homes at wider spreads and list them. And so for me, I would like to see them reaccelerate purchases, provided that they're wide spreads and they feel like they have good exposure into near-term home price dynamics. But yeah, I think those are sort of the variables that I'm thinking about with regards to their purchase cadence.
Got it. And then the 7,000 that you said they had under contract at the end of Q2, though, I guess, wouldn't that imply that 7,000 out of the 8,000 were purchased at less than favorable spreads?
Yes.
Got it. Okay, so then like only 1,000 of them have those like double-digit spreads in this Q3 cohort.
Not necessarily. I guess I'm just saying like I don't think it's 7,000 exactly. Every single one of those were bad. I guess I just mean it's it was a bigger number of people. I think if you just say, okay, we had 17,000 homes, that's the number that we have to get through, et cetera. I think that is probably not helpful to think about how deep a hole it is because they had so many homes under contract. Not all of those homes were bad. And the number is lower than 7,000 for sure. But it just means that they have a lot of inventory that they had to get through, and one quarter was not going to be enough.
Got it. That makes sense.
They started increasing spreads. Like they mentioned, they started increasing spreads already on the last earnings call, right? It is something that they started doing like mid-May. So some of those 7,000 already had increased spreads, obviously with different expectations, but like generally the purchases, I don't know if we can make an accurate statement here, but like starting August, that's basically what Tyler shared as well, is the embedded margins and the sales margins look really, really good. And some of those homes, some of those offers were made like in Q2, end of Q2, right? So
Yeah.
I think they had a good pulse on that very, very early. It's really great to go back and look at what they said in the Q2 earnings call, because I mean they were seeing it unfold way earlier than we did in the data. So that's definitely worth looking into again before the earnings call on Thursday. Something I wanted to add is I'm really looking forward to their comments on purchases. Something that I really appreciate about Opendoor, they're really open about like what is happening in their business and going and making a forward-looking statement. If you go back to Q1 earnings call, they're talking about how the back half of Q2 will be quite challenging and how they will adjust purchases, etc. It was a bit more challenging than they expected to, but like they're not afraid of giving long-term like a long-term estimate. So what I'm definitely looking for on Thursday is that they tell us about how their purchase strategy will evolve the next few months, when they expect to increase purchases, what the conversion rates of their offers are right now. Like we don't know if they have a low amount of purchases because conversion rate is bad, or if they're just decided to buy less homes. We assume it's the second one because that makes the most sense, but like I really hope we get answers for that on Thursday. So,
got it. Super helpful. And then just last question that I have is, you guys said that just to recap, you guys said that they were incentivizing their salespeople to sell more homes in July and August, I think. Is that right?
September.
Got it. And they were incentivizing their salespeople to sell more homes in September. I guess your estimated EBITDA margins lower than guidance. So if they're if their say sales and marketing expense potentially increase, what do you think is driving the delta or the beat in the adjusted EBITDA margin?
So we're accounting for that in our estimate. So I increased costs, the cost of selling costs and holding costs when I made the adjusted EBITDA measurements. So I think I increased them by like 30 to 40 basis points total. And that's my commentary on these is that I can't accurately estimate selling costs or holding costs because I don't know the HOA fees or the insurance premiums that Opendoor pays on all of its inventory, et cetera. But, generally their sale costs and holding costs combined is 3.5 to 3.6% of revenue. And so I increased it to 3.8, 3.9. So that's kind of how I accounted for that.
Right. And so then I guess like what are you accounting for in the beat to their guidance if they have higher holding and selling costs, but your adjusted EBITDA margin still comes in relatively better compared to the guidance?
Well, so it's just a function of the fact that they have much higher revenue. So economies of scale are kicking in, and so the costs.
Got it.
They were guiding for.
Yeah,
exactly. Their fixed costs are spread across more unit sales.
Got it. Okay, that makes sense. Thank you, guys. Super helpful.
You're welcome.
Hey Tyler. Hey Sebastian. Can you hear me?
Hey Tyler, this is Manny. I had a question. So we know that they charge a 5% fee to the sellers, and then it looks like the terminal rate. Somebody made a comment that it could stabilize around like 7%. I don't know what is their cost of borrowing. So that's gonna roughly add, 2%, to the cost, potential headwind. And then they would have to widen the spread, right? I don't know how much on an average, if they forecast the sale price to be X dollars, I'm guessing, and it takes like 6 months, 3 months, 4 months to sell. So potentially, I think it's going to add roughly 2%, maybe 2.5%, in terms of like interest cost to hold the homes. It's going to take them longer to sell. They are embedding much higher embedded spreads to account for potential decline in prices. What gives the confidence, or I think you made a comment that you would like to see them increase the purchase volume, but I feel like, I'm in Atlanta. Every week I'm seeing like, kind of like what happened in Phoenix, 3 months, 4 months back. Maybe you're seeing this in your data. Every week more homes are coming to the market. The homes are having a price cut like every 2 weeks. It feels to me like, I think I made a comment similar to this even in the previous call, where I think maybe different markets will have like different impacts, at different points in time. I feel like in Atlanta it's starting to happen slowly. What gives you the confidence that they should purchase more homes and hold the balance? Because if you ask my opinion, probably it's a better strategy for them to like, don't acquire any homes, kind of like just go back to the basics, clean up your balance sheet, and then probably wait for the
Mm.
right time, to increase the acquisition, right? So can you add a little bit,
Yeah.
yeah, yeah.
Yeah, that's a great question. Thanks, Manny. Um, I think it's important to start with at least my position that um, for Opendoor, iBuying is the only business, right? It's the only thing that they do, and so if they stop doing unit sales, the company dies because they have so many fixed costs that have to be offset by these volumes, and so if they slow down and remain slowed down, losses will persist for longer periods of time. And so the best move, in my opinion, for the company is to get back to high volume sales and purchases as quickly as possible. And so we start to get in the question of, you know, how can you have the confidence in a higher interest rate environment that this company would do well? And I think that goes back to the original thesis for Opendoor, right? Is that, it's been dented, but the idea is that the company fundamentally should do okay in a down market, as long as it's not too fast of a down market, because during uncertain times, liquidity premium is never more valuable. And so you actually start breaking down interest costs. We raise interest rates by 3%. Opendoor holds homes, let's be conservative and say they hold them for 4 months. Really, Opendoor just has to widen spreads by 1% to make back that cost. And I think in uncertain times, they can definitely charge 1% extra to pay off their interest fees. So that's a part of it, right? Is that, these interest rates are more navigatable than people think. The other thing for Atlanta, based on our data, Opendoor's gross margins by purchase month for the months of October, September, and August for Atlanta are all double digits, and actually trending higher. So I think you start looking at these more recent months and the types of margins that they're expressing in Atlanta, and it's like, geez, even if Atlanta had a horrible couple of months, Opendoor is still going to do quite well, and that's because the company has this more aggressive, conservative positioning. Um, you know, they can't do that in a market like Phoenix. If Phoenix keeps going down, Phoenix is going to continue to be a very bad problem. But in the markets where they have right-sized inventory, I think it's really important that they continue with their transaction volume.
And you think, people will convert even if they offer like 10% less than the current value of the house? Because honestly, I don't know how, Opendoor can cover all of the cost, and
Yeah.
with like increased spreads and all of that, they would have to offer at least 10% less than the current market value for the home. So you think the conversion is not severely impacted due to the uncertainty?
I think that what we're basically talking is the price elasticity of demand curve. And in a down market, I expect that you can offer less for a home and conversion will either stay the same or be higher. And so if Opendoor has to say, okay, we're only going to get 20% conversion, but we're going to get, an extra 500 to 1,000 basis points on all of our inventory, that's our margin of safety. That's one way of looking at it. Maybe you convert fewer people, but the other thing that's important to consider is that Opendoor just struck an exclusive multi-deal relationship with Zillow, which broadens their funnel by a factor of 10. It means that they can be picky about the homes that they decide to purchase, which means that they can afford to offer lower prices for all homes and still maintain their absolute number of converted purchases. And I think this is all strategic positioning by the company so that in a down market, they can continue to maintain volumes and margins.
All right, let's get Kartik to ask his questions. I think he tried now multiple times.
Oh yeah, thank you, Sebastian. Thank you, Tyler, as always, for putting this together. I have a question about I'm as a the bullish thesis is Opendoors comes out of this period, however long it lasts, and some of the other iBuyers don't succeed, right? So you have more of the market for yourself in some ways, but on the customer side, I mean, the promised land is that people in the future convert to buying and selling homes through Opendoor. I'm curious if you are collecting any signals, whether it's from the App Store reviews or any other data sources, which gives you a sense of how much are people actually transforming to this new way of buying and selling homes. For example, are you able to collect any data about, if someone buys a home through Opendoor, what are the chances of them buying or selling another home through Opendoor? I'm just curious if you have any demand side metrics.
On the second question, I let Tyler then jump in on the first one. We actually see quite a few transactions where after a seller bought or sold a home from Opendoor, they do it again a few years later. We probably have to write an article on that and dive deeper into that data, but it's something that I've noticed. So I really wonder, and I don't know the answer to this question yet, but if Opendoor customer is more inclined to sell the home early and move again earlier because it was that easy. It's probably something we have to look into for a future article. But Tyler, do you have some insight on how people are going towards more of an Opendoor model to selling and moving their home?
I think it's a great question. I'm not sure if we have a good metric for it. I mean, it's basically like reactivated users for Etsy, right? It's really thinking about Opendoor as this platform that people can use buy and sell homes. We haven't written any programs to say find duplicate owners over the course of all transactions, which, Sebastian, we probably could, given the size of our database, the number of transactions we have in our database. But it's an interesting question. I do think, to sort of more firmly answer your question, one of our biggest goals for a metric, or at least visualization in a data door, is to build a visualization of Opendoor's market share. Not just in the United States, but in the individual markets in which it operates. And I think that's really telling, perhaps not from a reactivation standpoint, but just in terms of which way the wind is blowing for U.S. residential real estate. Because in early 2021, the first quarter, that's when we really saw the peak of iBuying's presence in the United States, and I expect it to continue to balloon upwards. Although it's been sort of drowned by this housing volatility and this downturn, fundamentally, this is an easier way to buy and sell homes, right? And I think at scale, with other ancillary services added on, be actually the more economic economical way as well. And that's really the dream for the company in my perspective, is if you can get to a point where spread is less important and the ancillary business opportunities and the economies of scale offset your fixed costs, and you have a quite profitable business without having to offer much less per home.
Yeah, I agree, and thank you for that perspective, because right now a lot of the data that we're looking at is in some ways validating if iBuying works in this current environment and if Opendoor can survive and thrive. But I feel like as we go forward, for the business to really succeed, and if it has to become the Amazon of retail, or sorry, residential homes, the customers side becomes even more important, for the whole thesis to come alive. So yeah, any data around like customer purchases, reviews, all of those things, I think would be really, really helpful.
Thanks, Kartik.
Do we know if there's maybe a reason why weekly purchases have been going down so much? Like, is maybe are some of the banks withdrawing financing that we know of, or is there a different reason why purchases are going down?
No, we kind of chatted. We kind of chatted about this a little bit earlier, but I think there's a lot of potential reasons for it. Right. So it could be because Opendoor, realizes that they have a lot of inventory and they want to right size, focus on selling, and don't want to catch any more falling knives of inventory. It can also be conversion, although I think that this is likely not a big impact, or certainly not as material as the downslope of purchases would seem to suggest. But I don't think it's really financing related, just because of their access to capital, and we don't know a lot of the more technical details of their debt covenants, but I don't think lenders are saying we're not. They're fully committed, right? So they have access to those funds.
Hey guys, on the last earnings call, in my own personal opinion, I thought that analyst questions were lacking and the call seemed to end pretty quickly due to a lack of questions. I was curious if you guys have any relationship, kind of the Datador team, with investor relations, anything beyond just a generic kind of retail investor. And if not, is there any roadmap that you've seen like other communities use to try to become, I don't know, more involved in the conversation? I think Palantir has retail investors at least submit questions.
Yeah.
So is there anything that you guys are thinking about or trying to do?
It's a great question, and I've had several conversations with Elise, who's their head of investor relations. Yeah, I think it'd be really helpful if we were able to ask some questions, and I've talked to her about even more than that, like talking to company leadership on a podcast or some type of interview where we could ask questions that we feel like highlight the strengths and the weaknesses of the company, but really come from a place that's been deeply researched and hopefully is thoughtful and useful for the community. I think one of the most important jobs for early stage startup companies that have big, bold ambitions is to be a story and to tell their vision for how they expect or how they believe the company can change whatever industry it is that they're operating in. And we haven't seen enough of that, in my perspective, from the company. And I think in some ways that's made space for our community to grow and for our content to be seen as more valuable. But at the same time, we made Datador, and I began writing about Opendoor because I wanted the thesis, the idea of iBuying and modernizing and revolutionizing residential real estate to be more understandable and not less. And I think that we could use a tag team from management in that regard. And so I've sent some emails. I know that they're busy and they have a lot that they're working on right now, but so far it hasn't manifested in much in terms of a relationship. And so we're kind of just being patient on the sidelines and trying to see if we can help if we can. But other than that, there isn't an obvious roadmap. I think other companies are more interested in talking and including retail investors. But yeah, we'll see if that changes over the next few months.
Maybe one more for me, and sorry for coming in late. Maybe I missed the part. The institutional buyers of Opendoor properties. Do you know if there's a change in their buying behavior? Are they still buying with as much fervor as they were before?
Sebastian, do you know the answer to that? I know we paid sort of close attention to the institutional buyer rate in the past, but I wasn't sure if that was something that you were still monitoring.
Yes, I'm just looking at data right now. It's basically at the same rate through July, August, and there was a jump in September, obviously, because they probably wanted to get rid of a lot of homes. So actually, September had one of the highest rates of institutional sales, but other than that, it has been stable. So institutions didn't shy away from buying homes, at least at a percentage of all Opendoor sales in those months.
Hi guys, couple things. First one maybe for Sebastian as well. On your Datador, like Adam's website, you have your estimated gross margin. Have you guys thought about doing contribution margin after interest? Because that speaks to the actual unit economics of each house. And then we can sort of backtrack and work out scale to cover their fixed costs from there. And to see how reasonable that sort of scale is. And then second, Eric Wu has been known to say that he's obsessed with overcapitalizing the business to prevent it from going bankrupt. And it would suggest to me, with the cash they have left and their current burn, they've got somewhere in the realms of 6 quarters, probably a little more of burn, depending on how the next year goes. That would suggest to me that he would be starting to plan another cap raise within sort of 6 to 12 months. Wanted to know if your thoughts on that, given it would be quite dilutionary at this current stock price. And then the last thing was based off their sort of last quarter margins and this quarter, it would suggest to me that their pricing model is somewhat smoothed and overfitted. So in the long run, they're fine because they're participating the ups and the downs, so that it should average out to the middle. But it then leaves quarters in particular to be very volatile and for the traders in here, potentially something that you could trade off very easily. And just wanted to get your thoughts on those things. Thanks.
Yeah, sorry. Can you just go through the? I was thinking about your last question. What was your first question?
Yeah, sure. If you guys are planning on adding the real-time data,
we aren't. We are not planning on adding things like interest or write-downs or stock-based compensation, things like that. Just because we can't measure them. And so I actually thought I was pretty impressed with ourselves for including things like adjusted EBITDA and contribution profit margin. Even though we can't measure things like holding costs and sales costs, like I thought that was pretty cool. But like part of that is because sales costs and holding costs have been so stable relatively over the past, many quarters. And so we felt comfortable being able to use those in our estimates. But things like interest on inventory, it's such a moving target that we aren't going to include that in our estimates.
Yeah, fair enough.
And then your second question was
about whether you think they're going to do a cap raise within 6 to 12 months and how dilutionary that will actually be.
Yeah, I mean, I think that would be really challenging for this company. That said, they did have $2.5 billion in cash, $700 million in equity. I don't expect them to lose. Let's be really conservative. I don't expect them to lose $1 billion in the next 2 quarters, and certainly not including Q1 either. So I think that they really did put themselves in a position of strength to raise before growth stocks fell from the sky, and they have a decent sized balance sheet right now. I would be pretty devastated if the company tried to raise at these depressed levels. So I don't think. I would imagine that they would get a little bit more creative than that if they really needed capital.
And the last question was,
just your thoughts on trading the quarterly sort of volatility in their margins, because it seems to me that their pricing model is very smooth. So they participate in the ups and the downs, at least partially.
Yeah, I think so. I think I don't know if you're a biology guy, but if you think about this in sort of the Punnett square philosophy of like, okay, how does Opendoor do in an up market, in a down market, in a fast market, in a slow market, and then sort of combine those variables? The only market that Opendoor does bad in is a fast, slow market, right? And so, yes, I think your comment is prescient for current times, but over a 10-year period, over a 50-year period, we might see 1 to 2 of these events. And so I think in the context of that, they're participating, probably in a more positive direction than home sellers, certainly in a down market. And in an up market, I think that they're probably participating a little bit less because they have to offer more to convert. But even still, it's gravy, right? Because it's HPA, and so that gets added on as margin. But overall, I would say like the only market that they're really vulnerable is a super fast down market. And other than that, as long as U.S. residential real estate is not going to be super fast down market, for the next 10 years, they should be relatively well protected in terms of other cycles.
yeah, I think what we're seeing in terms of gross margin is seasonality, right? You see Q1, Q2 being very strong, and then Q3, especially Q4, being quite weak, because that's when most of the country is not buying or selling homes. That's when volume goes down quite a lot. That's just a seasonal to their business, which we didn't see in the earlier quarters, because after they IPO'd, they kind of had to ramp up again to the level they were before the pandemic. But that seasonality should be there from now on every year, right? You will see a strong Q1, Q2, and then a less strong Q3 and Q4. I'm not sure if you can trade on that. Like we haven't seen much correlation between the data in Datador and the stock price. Unfortunately, it's hard to predict the stock price, because like in Q1 and Q2 everything looked really, really good, and I don't think anybody could have predicted what happened in the beginning of Q3. But the stock price didn't do well, right? Probably because of other macroeconomic reasons, but yeah, it's hard to predict the stock price.
Yeah, maybe long term, once they hit a sort of more steady state, you could do seasonal trades with it.
I think that probably makes more sense, and maybe when they're bigger and they're kind of moving markets in their individual markets, I think that there's probably more of an argument for that as well. That these data, I've said this a few times, but like if Opendoor is responsible for 1 out of 10, 1 out of 20 sales in every market or in a given market, I think their sales behavior, their margins, and the prices that they're selling at is much more insightful data than just the data of performance for a $1.6 billion market cap SPAC that has been thrown out with the bathwater.
Yeah, definitely. Thanks, guys.
Tyler, you said something about 10x potential for leads coming through Zillow. What do you base that on? Do we know more about how that collaboration is gonna look compared to a quarter ago?
Yeah, Mike Del Prete did an analysis of top of funnel between Zillow and Opendoor, and it was the number of seller leads that come through Zillow is roughly 10 times the amount that comes through Opendoor, and so that's where I pulled that number from.
Gotcha.
Yeah, we haven't heard any updates yet on where that Zillow partnership is at. Hopefully we hear something on their earnings call from Zillow tomorrow, or obviously on Opendoor's earnings call on Thursday.
Hey guys, can you describe at all what the enterprise product is? I know that there's not a whole lot been said about it, but obviously it seems like it's something that has some potential for some bigger earnings. Do you guys know anything about it?
Yeah, great question. Man, if they talked about Opendoor Enterprise on the call, I think that would be a hit too. But the basic idea is that companies that buy and rent homes at scale, so like the Tricons, Invitation Homes, right, Blackstone, those types of companies, they're still using, in a lot of situations, and perhaps not all, but in a lot of situations, they're still using quite rudimentary software to make those purchases, to make those deals. They're using spreadsheets, right? There's not a software infrastructure to assist REITs, to assist landlords with buying and renting homes at scale. And so that's not just the purchase, right, but also the AVM, also the title and escrow, also the closing and the inspection, the appraisal. All those different components are sort of puzzle pieces that are scattered and fragmented. And so what Opendoor realized is that this product actually serves its flywheel in a lot of ways, because they can be the infrastructure player, right? Like the software middleman for these landlords to buy homes, by providing them with all of their learnings and all their technology and operations. And so it should work out to be a very high margin business, albeit probably a much lower revenue when compared to the fact that Opendoor counts home sale dollars as revenue, but still probably would be meaningful to the bottom line, even at low scale for this type of product. But then you think about the other advantage here is partnering and serving these massive home buyers means that they can connect these home buyers with sellers on their platform once they decide to make that a product. And so that's part of the reason that we've been so excited to see, these design ideas and these rumors about Opendoor offering a marketplace for sellers, because Opendoor can connect those sellers to these many institutional players that use Opendoor's products. And so it's not just individual home buyers that they can connect sellers with on their platform. It's also these institutional players, and so it just makes for a much stickier environment for their product. It's a high margin service, and I think it's actually it's a much bigger business opportunity than I think people give it credit for.
And to double click on that, what made me really exciting about the work we've seen on Opendoor exclusives and the sales side of that, with we don't know what the name is. It's probably Opendoor Connect. That's the name of the entity that works with those sellers to sell their homes on Opendoor exclusive. What we saw there is a new experience where the seller actually sees multiple offers from multiple parties. They see their cash offer from Opendoor. They see other offers from real buyers that are coming through Opendoor exclusives. And you can imagine in the future, they could see offers there from institutional buyers directly. So if BlackRock wants to buy your home, you will see their offer there together with all the other options. What's important about this is that there has been a lot of backlash and bad press around Opendoor selling to institutions, like taking away homes from real families is really the argument there. And by giving the option to sellers to decide on their own, giving them the agency to sell, to say, am I going to sell to a real buyer? Am I going to sell to Opendoor or to an institution? Could help with that perception, right? Because Opendoor is not making the decision for the seller, like how it might be right now when they're buying, giving a cash offer to sellers, and then it's up to Opendoor where the home ends up in. Giving the agency to sellers really like shifts, you could say, the blame in that regard to the sellers, and it could help with the whole PR problem around the institutional side business.
Yeah, I think that's a great answer, Sebastian. And just to sort of dovetail this, because this gets me so excited from a consumer perspective and also an investor perspective. But just like, why isn't it always like this? You know what I mean? When I first started looking at the Opendoor thesis, this is what I kept thinking in my head: is they're finding ways to solve analog problems where you look at the solution and you just say, why isn't it always like this? Why do I have to list my home and let strangers into my house and go through all these steps with all these offline parties who I've never met before, and talk to all these different people? Why can't I just list my address on a website, provide some information, and then a company finds potential buyers for me, and I get all those offers in my dashboard, and I can choose who I wish to do business with based on whatever I feel like are my own principles. I think that's what's so cool about this, is that Opendoor is coming up with solutions which sound crazy if you brought them up 5 years ago, but then when you really think about them now, it's like, why doesn't this already exist? Why isn't this the way that we do our largest transaction? And I think this third-party marketplace, which will be fed by the relationships with these institutions, they're passing along institutional advantages to the regular consumer, and I think that makes for an incredibly wonderful value proposition for the customer.
And if you think about it, Opendoor is probably the biggest aggregator of real estate seller leads in the country, right? The amount of people that entered their email address and their actual address to Opendoor and get an email from them every time the offer changes is in the millions. Like, even Zillow doesn't have a seller funnel like that. Zillow has a lot of buyers. They aggregate a lot of buyer interest, but not really seller interest, right? And Opendoor did nothing to really monetize that. They don't want to give those leads to agents like Zillow would be doing. They just use it for the iBuying business. And this is now the next step, to take their position as an aggregator and give more options to sellers that are maybe they're higher margin, less risky, and still help. And still, their iBuyer business is important because that's what actually aggregates the demand. Like, people should start their journey of selling or moving by requesting an offer on Opendoor, and now they get multiple offers, right? And they can still choose to go with an agent and list it on the open market, but they will be more informed. They will have a baseline of offers and that they can always go back to. All right. Any other questions?
This was a lot of fun, guys. Thanks so much for everyone who showed up, everyone who asked questions. We really appreciate your support. This is our second quarter as a company, and we really couldn't believe when we first started this that we'd be in this position right now with the size of the community that we have, and and all the support. So we really appreciate it. I think it's been a tough year for the company. It's been more than a tough year for the company. But I do think that things seem to be turning around, and I'm excited to hear more about it this Thursday. So feel free to reach out if you have any follow-up questions. Like I said, we really appreciate you guys so much.
Thank you, guys. Have a great evening.